So it's a pleasure to be here today with Danny Masters from CoinShares. My name is Garrick Hileman. I'm the head of research at blockchain.com. And let's just jump right into it. We're here to talk about gold. Danny,
Sure.
why don't you, if you don't mind, start by just introducing yourself and CoinShares.
Yeah, well, thanks, Garrick, and appreciate you and Coinscrum setting this up. So I'm the chairman of CoinShares. CoinShares is a multifunctional digital asset management company. We have passive exchange-traded products. We on NASDAQ, OMX in Sweden, some other exchange listings. We have funds. We have gold token, which I think we'll be talking about today. We have an index product, and we support that product suite with various other functions, including a very active trading business, CoinShares Capital Markets, custody business, Kimenu, which we do in joint venture with Nomura and Ledger, and also research functions that get a very wide reading and good audience that cover such things as mining, individual coins, multi-coins, altcoins, and so on.
Great. So you mentioned gold and our product DGLD. I think first thing we should just disclose, of course, is that CoinShares and blockchain have a partnership around the DGLD token. And so I think it's important for listeners to be aware of that as we talk about gold, some of the competing ways of owning gold, including other tokens. But maybe we could just start with the kind of investment case for gold in general, and particularly for our cryptocurrency audience. We'll get into in more detail maybe gold versus Bitcoin later.
For the cryptocurrency investor, I'm sure, like me, you are an active cryptocurrency investor, as will be many of the audience members. And we're used to very, very high volatility. We're used to experimental kind of products and new networks, and I think many of us have been fortunate to be involved in some of the more successful ones, although we're all involved in some of the less successful ones as well. But fundamentally, I think you can view the cryptocurrency activity as having sort of two legs. One leg is I'm exposed to cryptocurrency. Now that can be in your wallet, it can be in cold storage, it could be on blockchain.com exchange, or many other variables. And then you've got, when I'm not in cryptocurrency, and in that sense, there are a number of other options. You could cash out your cryptocurrency and withdraw the money into a regular bank account. You can flip into another form of stablecoin, USDT, USDC, Gemini coin, and so on. Or indeed, you, as in our case, can seek out a stable coin backed by some other asset. And so obviously that's where DGLD and gold tokens sit. The premise, I think, is, look, let's be honest, there are many very effective ways of trading gold through ETFs, through physical gold, through gold futures, through gold swaps. Even apps like Robinhood and Revolut now have sort of a gold tracking kind of instrument that you can very easily buy. But I think the gold, the idea for a cryptocurrency investor in a general sense is, here I am, I'm trying to get out of the volatility of crypto and into something more stable. So the question then becomes, what and how do you do that? And my feeling about gold, and I think as the blog post that you forwarded me earlier, I'm sure you'll send to the audience, it's extremely good. Details quite a buoyant picture for, I think it alludes to that for stable coins in general, but also for gold coins. And particularly for gold coins, I think for the cryptocurrency investor, when you're used to trading Bitcoin or you're used to trading Ethereum and, you've experienced volatility of upwards of 150% annualized, when you're getting out of risk, you're getting out of risk down to something that's much less volatile. Now, gold has an annualized volatility of about 6 or 8%. Maybe a little heightened at the moment, but that would be the long-term average. And by definition, dollars, pounds, euros, yen, renminbi basically have 0% volatility, depending on what your base currency is. But when you're looking down at low vol from the lofty altitude of 120, 150%, whether you are getting into something with 0 vol, 2 vol, or 8 vol is really immaterial. You're getting out of the really volatile stuff into something less volatile. And I think So that's kind of rationale number one. Here's a way to book your profits, avoid a downturn, avoid your risk, and park your capital somewhere else. Now, obviously, with a gold token, the benefit to a cryptocurrency investor is that instrument's available on the exchange or within the wallet that you're currently using, and you don't have to take that Bitcoin out, sell it for dollars, and go buy an ETF. So, for the cryptocurrency investor, you're within that framework. And then the second reason, I think, is there's two more layers to this. One is we can all see, what's going on, with the Fed right now. You can look at the Fed balance sheet. The Fed balance sheet, which sort of crept its way up to about $4 trillion, after the world financial crisis, and was very, very slowly starting to decline in the fall and the winter of last year. That balance sheet has now absolutely exploded, and that will top out somewhere probably around $20 trillion. And if you look at the the decline that we eked out over a number of years to bring that balance sheet down from maybe 4 to 3, we've just blown the doors off. And not only that, but every other central bank in the world, from Bank of Canada, the Bank of New Zealand, Australian Central Bank, British Bank of England, European Central Bank, everybody has just ballooned these balance sheets. Now let's just think about what that really means. No one's ever proven that once QE is out, it's a bit like the genie in the bottle. You can't get it back in, because what you need to do to get it back in is you need to tighten monetary conditions. And when you tighten monetary conditions, whether you're selling out bonds that you bought, which bond selling, higher rates, probably in the longer end of the curve, or you're raising short-term interest rates, rates higher in the shorter end of the curve. Add that to the ballooning, commercial, government, and private debt burden that the world is suffering under, and those rate increases are politically untenable. And you saw the first kind of real tangible instances of this when Donald Trump called out Governor Powell of the Federal Reserve towards the end of last year and was saying, hey, what are you doing? Interest rates are too high. You need to lower rates, lower rates, lower rates. And all he was trying to do at the time was rein in this QE. So the genie's out the bottle. And let's put this in really simple terms. I mean, you talk about QE at central banks, it sounds confusing. But in simple terms, it's this. When you create more money, right, that money is just a denominator for the goods and services that are available on the planet. And that's a double-edged, a double whammy in this case, because you're creating more money, much, much more money, while the base load of goods and services are actually shrinking. And this is very, very dangerous in my view. It's very dangerous for fiat money. And there are many examples of fiat money that have failed dramatically for exactly that reason. In fact, if you go back to the Weimar Republic, probably the greatest ever example of a currency sort of imploding, the detail behind that event was that the German government, after the First World War, were very reticent about paying the reparations that the Allies were demanding. Germany went on strike. But the government decided to keep paying people anyway, which is eerily reminiscent of what's going on right now. And that got out of control. It got out of control, and the Weimark, the Deutsche Mark of the Weimar Republic, went through a hyperinflationary phase. So anyway, back to our cryptocurrency investors investing in gold. The first question you have to ask is, if you're getting out of cryptocurrency, do you want to be in dollars at all? Because there is a headwind in that dollar holding, which means that your dollars are essentially being diluted. You are being diluted as a shareholder of dollars by this enormous QE. So that's number one. Number two, if you do make the decision as a cryptocurrency investor to be invested in fiat, notwithstanding these effects of QE, then how do you want to do that? Well, you can take that money out of a bank, and put it in a bank, like we said before. But if you choose to buy, USDC, USDT, Gemini coin, and so on, you face another risk. And I'm not trying to be alarmist. I'm not, an anarchist. I'm not a doomsayer at all. But I'm actually talking to you from my residence here on the island of Cyprus, and it wasn't so long ago that Cyprus had a financial crisis, and the Cypriot government removed all balances in people's bank account in excess of 100,000 euros. So if you had 10 million euros, you were left with 100,000 euros. And I don't think we can rule that out when you look at ways that we are going to perhaps try to pay for the enormous subsidies that are being handed out left, right, and center at the moment. And so, you know, I hate to tell our listeners this, but the fact is that, and with no disrespect to my stablecoin colleagues, you know, I think a dollar stablecoin is lipstick on a bank. And the fact is that every transaction does have to clear a bank, and all the balances are held in banks. And therefore, if that bank, like all banks, suffers some sort of macro haircut or wealth tax or something of that nature, which you cannot rule out at this point, then those coins are going to deflate, and they're going to deflate exactly in proportion with whatever haircut you get. So that's the second layer. And what's cool about gold in general, and cool about gold tokens in particular, is that gold is such a unique commodity, and because of its long history, and because of the way it's become an international sort of clearing asset for central banks when they borrow and lend to each other, gold exists entirely outside of the banking system. And banking regulation and financial services regulation in general, so long as the gold you're talking about is of a certain kind and allocated in a certain way, that gold escapes all central bank, governmental and regulatory policy. And therefore, it really is the most secure and stable form of value that's currently available in the environment we're looking at.
Great, thanks for that detailed explanation there. And you know, thanks for also mentioning the report, which we'll be publishing soon here, more officially on gold. It's a 30-page research report that gets into some of the points you made. In particular, the growing adoption amongst many central banks of gold, which is interesting. Rising powers like China, India, Turkey have been building their gold positions in recent years. And this is one of the things we highlight as one of the big kind of distinctions between gold and crypto assets like Bitcoin, is the fact that gold is much more mature, more established, and widely owned by central banks, and has been proposed as recently as the last great a possible new Bretton Woods II style system. Zola, president of the World Bank, 2010, just still in the early days after the financial crisis, published an article in the FT advocating for exactly that. And so as a hard asset can restore credibility to money. There's an argument that central banks and institutions, because they own a lot of it, would look first at something like, say, gold. If they had to go there, there would be a lot of opposition amongst many economists and others to kind of going back to gold standard. But if they had to, they would probably turn first to gold, arguably over, say, something like Bitcoin or some crypto asset they don't have a strong holding in. In your view, is there still an argument for owning physical? You've taken this step to say, okay, I'm going to move beyond crypto assets and stocks and own some gold, and I'm interested in owning a digital version of gold. Is there still a good argument for owning physical gold as a complement to your digital or ETF?
You mean in physical form?
In physical form,
pure
yes.
Physical form. Well, let's analyze that. Let's analyze that. So a really good gold vault would be one operated, by a sound, very reputable third party. It would be one where there's very little slippage in terms of either acquiring your gold, getting your gold out of that vault, putting gold into that vault. And what you find, and certainly, the gold, for example, that backs DGLD, this gold is in 400-ounce bar denomination. So each bar is about $800,000 now. And that's not really, a workable situation for your average investor. Now, there are lots of smaller gold formats. But again, once you get into the small gold formats, 1 ounce, 10 ounces, 100 ounces, you find that's essentially a retail product from a gold supplier. There'll be quite a big markup on that. It could be 5, could be 10, could be 20% of value. So the benefit of actually holding the gold in the form of a token in this way is you can hold a small amount without paying this enormous vig that you need to, while still benefiting from absolutely best in class, low friction, insured, robust, reputable storage. So there is, so I think there are really big advantages. Now, look, if you are fortunate enough to, have $4 million lying around and you want to buy 5 big bars of gold, and you will find a very efficient way to put them in a vault. Someone will charge you probably 20 to 30 basis points a year to vault it and insure it for you, and you can do that. But that's a very small number of people. I'm addressing a marketplace here when we're talking that really, could be essentially the retail ETF market, right? So someone's got $10, $20, $30,000 worth of a gold ETF. That's their, low volatility disaster scenario hedge. Well, now they can own physical Swiss allocated gold basically for the same economics as someone that's buying 5 million of physical. So it does give that access to allow people to do that. Mm-hmm. What we're also finding, Garrick, which is interesting, is people who even own vaulted. So that second class of people who are fortunate enough to have multiple bars of their own, they're tokenizing them too, because all of a sudden, their gold is there anyway. And now they have a liquid and tradable form of it. If they want to optimize, they can actually make payments with it. They can swap it for cryptocurrency on blockchain.com exchange. And it gives them a little extra flexibility. And in fact, I would tell you that a lot of the gold that we have on our token scheme is people that have done that. So it actually works both ways.
We've seen, a much stronger, more positive correlation between gold and Bitcoin recently. Given the macro environments, they're moving more closely together than they have historically. So that's, I think, one question that's on people's mind. Are we, should we expect to see that, more and more as we go forward? And then really, a lot of people look at, Bitcoin, of course, is a more volatile hard asset than gold, but it arguably has more upside. It's less widely adopted and can be used for all sorts of things that gold can't be. You've got companies like Microsoft maybe anchoring a digital identity system to the Bitcoin blockchain. And so I think maybe a lot of cryptocurrency investors are still a little hesitant or don't see the point of owning gold if they already own something like Bitcoin. And so I think it'd be worth kind of spending a little more time on that, the correlation, and also kind of, what we should expect going forward and why cryptocurrency investors maybe should think more about gold than they have historically.
Yeah. Well, to your first point, the correlation between gold and Bitcoin, that correlation was picking up and had become quite powerful in the early stages of the economic unwind that we're doing, and before, during the trade, the potential China trade war and so on. We did start to see a very interesting correlation between gold and Bitcoin. And I was getting quite bullish about that because, Bitcoin is like, if Bitcoin does give you that portfolio diversification that gold does, you actually need a lot less Bitcoin than you need gold, just because of its natural volatility. And it's also, also got some, anti-correlation benefits, within a portfolio, even side by side with gold. Because while they may not be correlated to, stocks and bonds, even gold and Bitcoin have their movements. And when you can decrease correlation, even if you don't make any excess return, you're increasing the Sharpe ratio of your portfolio. So that looked pretty good. The unfortunate thing, I think, that we need to be honest about is that we had sort of Black Monday in crypto when we dropped from 7,500 to 3,500 in one day, as the crisis really began to break out. And the simple reason for that, and you can see it on the blockchain, there was a lot of relatively new wallets, a lot of relatively new holders who had bought probably at an unfortunate moment, maybe had to liquidate because of other issues in their investment portfolio or leverage or margin calls, and we had a pretty bad day. And I think that kind of punctured that bubble to a certain extent. Now, since then, it's kind of been reestablishing itself. And I think one of the things you have to be realistic about is, you can leverage a gold position pretty well. You can go and buy CME gold futures, today's volatility environment. You probably get 4-to-1 leverage in an average account, but that's nothing compared to 100 to 1 leverage you can get on many cryptocurrency derivative exchanges. And so we'd left a little bit of a landmine in the Bitcoin space underneath the marketplace, where I think people were buying maybe ahead of the halving that's coming up in a couple of weeks. They bought already, a month ago. They levered 5 to 1, 10 to 1, 20 to 1. And we have a big down impulse in price, and that triggered a lot of stops, and that did some damage. That argument was, I think, temporarily punctured, but I think gold does come back as a good thing side by side for an investor that has a broader portfolio of currencies, stocks, and bonds. And again, just for the crypto investor, personally, I'm increasingly, when I'm rotating out of crypto, I'm increasingly using and thinking of using more gold-backed tokens for the reasons we said before. I'm not thrilled about the way the dollar looks. I'm not thrilled about the way the banking system looks. And I'm not thrilled about the fact that every time I do a USDT or a bank transaction directly, my money's sitting out there at the bank. And, if one day the music stops, I don't really want to be there. So I think those are the key thoughts that cryptocurrency investors should have.
That's something that's quite, I think, new in the history of gold, that tokenization potentially offers and could be interesting in a world where stablecoins in a negative rates environment, may not be, viable, or certainly run into real pressures that they haven't.
Yeah, look, you raise a bunch of really good points there. Just to address the first one, in terms of go-to-market strategy, we talked about the ETF buyers and the crypto investors as two classes of go-to-market. There's a third one, like you point out. It's the guy living in Brazil, Venezuela, Nigeria, where the currencies are under extreme pressure at the moment. I mean, probably the untold story of this crisis as we're going through it is how badly emerging markets are being beaten up. Brazil fell off a cliff last Friday. South African rand has been absolutely tanking. The Turkish lira is under a tremendous amount of pressure as well. And I don't think we've seen the end of that. In fact, you could argue that even as we come out of lockdown, the effects, pressures in the financial system will hurt emerging markets even more. Raoul Paul put a great piece out called The Dollar Wrecking Ball last week that I recommend people go look at in that regard. So, but yeah, look, we're working on some interoperability for DGLD. I realize the other tokens are already interoperable. There are some nuances there, but certainly, with a wallet infrastructure as big as blockchain.com's, why couldn't a currency that's under pressure, or a country that has a currency that's under pressure, kind of, either explicitly or implicitly see that gold-backed currency becoming much more viable? So that's one thing. Your second point about negative interest rates, it's extremely, extremely relevant. And let me just bring a few things into play. Number one, go check out Mervyn Goodfriend, a fellow of Carnegie Mellon University, former governor of the Federal Reserve, board member of the Federal Reserve. He wrote about this 5 years ago, talking about the zero interest rate bound and how physical money can't support as interest rates below zero, because everyone's going to say, well, I leave my money in the bank, I get 95 cents at the end of the year, or I take it out and I stick it on my mattress, and I don't. So he actually started talking about stable coins effectively. He didn't know he was, but it was stablecoin at that point. And that ZERP, as they call it, is really important. So that's great reading. And also, obviously, central bank digital currencies bring in real-time accounting, lack of stamps out the black market. There's surveillance, good or bad, around currencies. It's very, very powerful. And I think the fact the Chinese are now road testing a digital currency is really going to advance that argument. And so that specter of, on the one hand, China's going to eat your lunch and use a digital currency for international finance, and on the other hand, how am I going to impose negative interest rates, which are a real possibility? That speaks volumes to digital currencies. But those digital currencies may well come with a haircut, and that's where a gold token actually has a tremendous potential as a currency. And it's almost like a whole parallel new universe is creating. Beforehand, we had fiat money in banks and gold, and now you may have Bitcoin and central bank digital currencies, and they'll form the same kind of pairing of fiat and gold, Bitcoin and CBDC. And in a world where there's lots of CBDCs, Bitcoin doesn't look so strange to a lot of people. You can see Libra, the Libra Foundation, when they redid their white paper, much more along those lines of being single currency stable coins. So this is all connected, negative rates, the retail adoption of coins and wallets, the central bank digital currencies. This is all going to come into play, I think, in the next 12 months.
Great. Well, we're just about out of time here. I guess maybe a last question, and I know this is hard to provide a general answer to, but imagine you're a cryptocurrency owner. You do want to gain some exposure to gold. You own some Bitcoin as a hard asset, as a macro hedge. How should someone think about this from a portfolio perspective in terms of owning X amount of percentage of Bitcoin vis-a-vis gold? What's a good framework to begin to kind of think through that question?
Yeah, look, I mean, I think I come from the commodity space. When I started, in the mid '80s, there wasn't an investment thesis behind commodities, and that investment thesis grew over 20, 25 years and really turned the corner when it came to the Goldman Sachs Commodity Index. And what the Goldman Sachs Commodity Index really showed was that there was portfolio uplift for a portfolio of stocks and bonds when you added commodities. And those sort of allocations, for a bigger portfolio, for institutional portfolio, you might be talking about 0.5 to 300, but 0.5%, 50 basis points to 300 basis points of an allocation. Now, that's a huge number. Don't forget, if that's of the world's investment population, asset population, that's a huge number. Even if it's a shifting of that kind of allocation from gold into Bitcoin. So let's suppose you've got your 5% gold allocation, but you want 20% of your gold allocation to be Bitcoin. Given the fact that, gold's an $8 trillion market and Bitcoin's $120-30 billion market, that's a big number too. So I think you're talking, a handful of percent terms in terms of an overall portfolio. But a lot of people that invest in gold and Bitcoin are trading it. They're buying it because, they want to make a good return. And to those people, I'd say, look, to me, you're trading gold and Bitcoin. You're trading the same idea in two different forms. One's highly volatile and quite risky. One's much less volatile and less risky. And it also happens to be a good place to park your Bitcoin when you're not in Bitcoin. So those two, come into a bucket. And, my personal feeling at the moment is that it's sort of a technical issue. What we're seeing in Bitcoin at the moment is that the big spikes are getting quickly sold. And I think part of the reason for that is there's still so much leverage available that when people see a little pop, everybody jumps in 20x and tries to make, a quick $2,000 in Bitcoin. And that's why you see these little spikes up followed by big spikes down. But I think what's actually going to happen in Bitcoin, it's going to go in a shallow uptrend. And so I do feel like, the outsized returns of 20-30% in a day that you've seen in Bitcoin in the past, while they're both profitable potentially, but risky also, and quite alluring to investors, I think it's going to be much less of that going forward and a much more of a steady flow, gently upwards, punctuated by some of these, leverage-based pops. And on that basis, look, I think from a trading portfolio, as I said, gold is a little bit boring, but I'd be oscillating between, I always want to have some Bitcoin for sure, because I can't quite shake that idea it will explode one day upwards. But let's say that then that might be 80-20 to 20-80 over a period of time, just flipping between those two.
Great. Excellent. Okay. Well, I think we've hit the end of our time here. Again, if you have more questions about gold-backed tokens, the case for Bitcoin versus gold, come check out the blockchain.com research page or our blog where we're publishing this nearly 30-page report with lots of data and information. I want to thank Danny again for coming on, sharing his thoughts on this topic, and we'll look forward to hopefully seeing you again in the near future.
All right, Garrick. Thanks very much indeed. I appreciate it.